Welcome everybody, this is George Veter talking to you here at the end of August, summer 2024 for my monthly blog. And I'm grateful that you're with us. It's been an exciting month, hasn't it? We started the month early in August with a lot of volatility. We had a sell-off primarily in mega cap tech, and it was brought by the disappointing results of a carry trade in Japan. We can talk about that more individually as far as why that geopolitically upset the US market, but it created volatility. And then we had a weaker than expected jobs report and unemployment claims. So that could be interpreted really in two ways. It could have been really good news because it gives a greater probability that the Fed will lower interest rates sooner rather than later. Now it's kind of a given that he's going to lower rates, Jerome Powell, in September. That was kind of the nail in that coffin with that weak labor report. But then the negative people in the market, which there's a lot of them, there always is in the world, and we've talked about that before, those negative voices that are always there, started talking about the possibility of recession. And even though Goldman Sachs shows the probability of recession based on a weakening corporate environment at 20%, and we could look at that and say, wow, that's an 80% chance that we're not going to have a recession, but the market fixated on that possibility of possible recession for a minute, and it caused a sell-off, mostly in the stocks that were overreaching their valuations, which are the mega cap techs that we've talked about throughout the year, representing artificial intelligence and that great movement in artificial intelligence. So the Magnificent Seven that we've talked about in previous blogs. Anyway, those stocks got a haircut. NVIDIA, for example, went from $140 down below $100 in just a very short period of time, even though that still gives them a great return this year. They had a big haircut, a little panic that people were paying too much for those very popular stocks. Same thing with Microsoft and Meta Platforms or Facebook and all of those type of stocks. They all had haircuts. Now, there was also a great rotation in August. So a little panic over possibility of recession, a little concern over geopolitical issues with the carry trade in Japan, but also there was a rotation which was needed to keep the market healthy. Rotation meaning that buyers stopped fixating on just mega cap techs and they started looking at other areas where we had value. Dividend paying stocks, the Procter & Gamble's of the world that were mostly ignored last year by the stock market while the large cap tech went up and made our returns. Well, investors started buying those stocks back. And they also had a big rotation into small caps. So small caps had the best period of time in the last quarter than they've had in a long time, recent memory. So neglected market participant or sectors were bought back, and the overextended sectors were pulled in a little bit. And that's all positive. Bonds also have had a really great period because the idea of interest rates now poised to go down starting in September by the Fed, that would be the vast majority of analysts believe. That means that existing bonds that have years left to maturity that are higher yields will be worth more to the market because new bonds presumptively will be issued at lower yields. So older bonds at higher yields that still have maturity left are now going to be trading at a premium. So what does that mean for us? It means that our portfolio being just completely diversified into small caps, into value, into growth, into international stocks, and into two different bond categories, depending on the type of portfolio that you have, will have some mix of those. This is a beautiful season for us. Diversification matters again. We don't just buy the popular tech stock and feel comfortable at night. That's good for us. We've always played by the rules, and so this is helping us kind of even the playing field from the momentum kind of stock market we had for a bit. I also just want to mention that earnings have been outstanding. We're just drying up with earnings. We have NVIDIA coming this week, which will be a big deal, right? Because they're now the bellwether for tech and for the microprocessing chips and for AI stocks. So we'll see how they do. They're held to a high standard last time. They rallied on earnings, even though the standard was super high. They exceeded that. We'll see how they do. They're coming up, I believe, on Thursday. But so far, we have about an 80% beat rate. I don't know today what earnings came out, but before today, we were right at 80% beat rate on the S&P, which has mostly been announced. So we're still beating expectations routinely, which is a wonderful environment for more upside to stocks. Then also we have the consumer that continues to spend their money. We have the busiest vacation and travel season ever in the history of the United States right now. Hotel bookings and airline bookings are at all-time highs, not just a good year, but the best year. Because one of the positives of inflation is that people make more money. They usually have a wage increase, right? With a tight job market and things going up, wages go up. So that's benefited consumer spending patterns, which benefits you as stock market participants. So good earnings, good consumer spending, the probability of rate cuts starting in September all mean we have a lot to look forward to, an upward momentum, in my opinion, in the stock market. We're in the early innings of a bull market that was born out of the bear market in 2022. So I'm super optimistic. I just want to mention one more thing as it relates to us this summer. We have an election coming up in November, and it's a highly charged period of time. I want to reiterate, you've heard me, this is a broken record kind of, but there isn't a direct correlation between politics and economics. I mean, we've done well in the market under all kinds of administrations. There might be some hand-wringing until there's clarity in the polls, but the market went up after the Biden election. The market went up after the Trump election. The market went up after the Barack Obama election. So I'm just telling you that as soon as there's a little clarity, the market goes up. And that's in our best time of year. November, we're having the early Christmas sales and the holiday momentum that we typically get in the fourth quarter that launches us through Christmas, that launches us into the new year in January with new pension flows. So continue to have faith. Don't let yourself get negative on negative news. Look for a balanced approach to viewing the world, which there's more good things going on than bad things going on. And enjoy the balance of your summer as temperatures cool and opportunities to travel probably are more plentiful for most of us. So anyway, I look forward to our next conversation. Thanks. This is George.